Time now for today's Market Movers with easy-to-follow futures and options trades ahead of earnings.
Welcome to Market Movers. I'm Jim Urio, and we are again on the cusp of earnings season. Now, last time around was pretty solid, both in earnings and in revenues. Now, the time period between July 25th and August 1st, we're going to see 30% of the NASDAQ market cap, and that's just in 4 stocks: Facebook, Apple, Amazon, and Google. Today, we're going to look at using E-mini NASDAQ options to hedge risk or create additional exposure. A quick note, CME Group launched the Russell 2000 contract last night. I looked at the market just before coming on. It was pretty liquid with tight bids, offers probably 1 to 3 ticks wide. We're going to be watching that with great anticipation in the coming days because that was a great contract. Now, joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, the FANG stocks have done the majority of the heavy lifting, not just in the rally in the NASDAQ, but in the whole broad rally. Are they tired?
They're maybe not tired, but they're definitely under fire. It feels like every day there's a reason that someone is taking a shot at the FANG. So what you have to look at when looking at maybe something like the NQs, for example, is how much are the FANGs going to play into how that contract trades going forward, especially leading into earnings season?
Okay, let's just say they are tired and they fall off. Is there something else, another sector they're going to take it up, whether it be within the NASDAQ or somewhere else?
Well, isn't that the fun part of investing and trading? There usually is. The question is, which one is it going to be? It appears that financials almost want to take those reins. Certainly energy does not.
Right.
So I would look at financials, maybe industrials to some degree, but I still believe that tech, the FANGs, are the ones that you really want to watch for is how the overall market is going to go.
I agree that financials are the big deal, and also tier 2 tech, things that didn't participate in the original run-up. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary. When we price these out, the SEP NASDAQ's trading about 56.70. Scott.
So I do love the FANGs, I'll admit it, but part of my goal here is to find trades that I believe are appropriately priced given the risk-reward profile here. So I'm actually looking at put spread today to protect a little bit for maybe if you're long the FANGs individually, or maybe you've made some money in the FANGs or made some money in the NQ and you want to maybe put on some protection. So specifically looking at the week 4 July 5550, 5500 put spread, it's going to cost you about 10 ticks to put on, so about $200 of risk to make an $800 profit if that fills out that gap between 5550 and 5500. Expires on July 28th, so you get through most of those earnings at the end of the month. And that basically factors in some levels that were on the breakout of the NQs back in June and July, and some support that I think is there that could easily be tested.
I actually really like this trade, and I'm more of a bull, and I'm going to give a bullish trade, but I like this a lot. If you hold a lot of those stocks, I think it's appropriately priced, as you said, and if the bottom drops out, it may drop out rather quickly. I don't think it will. I'm actually looking at a call spread. I'm looking at buying the week 4 July, same expiration date as yours, the 5800, 5830 call spread for 7 ticks. Also expires July 28th. NQU underneath, currently at 56.70. Maximum risk on this one is 140 you put up to make 460. Now there's a couple different people who I think might be underexposed. People who sold off in the recent sell, and now they're wondering if they did the right thing, because if a good earnings season means they should have been in, you can kind of put a placeholder in by buying the call spread, or people who haven't participated at all are using this as a buy opportunity.
Well, and both of these exposures, Jim, have some nice wiggle room with them. They have good risk reward in the sense that maybe you don't want it to just fill completely out. Maybe you see it start going your way and you can take it off. My only concern is leading into what has been a really volatile period, or leading from a volatile period into what it could be a volatile period for earnings for the FANG stocks. Is there disappointment in the market that's going to come out even if the earnings numbers are good?
No doubt. And one thing we should mention too, with trading the options or the futures, a lot of times people hold these stocks. We've made that quite clear, right? With $113,000 worth of exposure per one contract. And when you use the options, all you risk on that is the amount you pay.
Use the volatility to your advantage as well. Because of that outlay that you have, the advantage of taking of there, you can obviously get on the positioning you need to maybe hedge out the long positions in your portfolio.
Thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're helping to make you a better trader.